Good morning, Guy Wagner.
Good morning.
Thank you for joining us for this new episode of Perspectives. It's difficult to start this interview without mentioning the escalating conflict in the Middle East. In an already fragile macroeconomic context, what impact is this likely to have?
I think the general idea is that it will make the macroeconomic context even more uncertain. Normally, financial markets don't like uncertainty, so that's not a good thing for financial markets. And then the other obvious answer would be that it increases the risk of a rising oil price. And again, that would not necessarily be very good for the world economy and for financial markets.
As you point out in the latest issue of Perspectives, despite the continuing global economic slowdown, there are pockets of resilience that are preventing the onset of recession. Can you explain this a little bit more?
Yeah, I think one pocket of resilience clearly is the US economy, which continues to do rather well. And within the US economy, it's essentially the services sector which continues to do well. This is partly explained by excess savings, consumers having not been able to spend money during the lockdown, but still they continue to get their revenue, so they have some kind of excess savings that they now draw upon to continue to enjoy life, because that's the other big theme. You only live once, so people want to enjoy life after the pandemic. So all this helps the service sector in the US. And the other thing is public spending. Budget deficits are high. In the US, the budget deficit is around 8%, which we had never in periods where the economy is doing quite well, where the unemployment rate is historically low. So it's very unusual for governments to have such high deficits during, you could say, good economic times.
Okay. And you say that the US is in a good position apart from the public deficit, but what about Europe? Do you think that if there is a recession, it will start in Europe?
I think you could say that the recession has already started in Europe, at least in the Eurozone. But what's important to note in the context of the financial markets, with financial markets, what's important is the US economy, maybe the Chinese economy, but the Eurozone economy is not very important for financial markets. So financial markets are looking to the US economy, to US interest rates, much more than to what's happening in the Eurozone.
Yeah, but what would happen if there was a recession? Should the average investor change their investment strategy?
Yeah, I would say the classic answer would be that normally during a recession, interest rates go down, so that's good for bonds, especially quality bonds or government bonds. And on the other hand, during a recession, normally company earnings suffer, they go down. So that's bad for equities. So the typical reaction would be to increase your allocation to bonds and decrease your allocation to equities.
Okay. It's good news that inflation is slowing in the US, although that wasn't necessarily the scenario that was anticipated. What is the reason for this improvement?
Yeah, I would say that the improvement in inflation to a large degree was anticipated because, first of all, you had the very favorable base effect. What I mean by that is usually you compare inflation for given months with the same months of the past year. And given that inflation was very high during the first half of 2022, comparisons for the first half of 2023 were quite easy because one compared the number with a high number the year before. That will change to a certain degree in the second half of this year. Then you had also things that had led to an increase in inflation, which reversed the supply chains, for example, improved again, so that also was clearly helpful. So I think to a certain degree, the slowdown in inflation was anticipated. Problem with inflation is that even though the official inflation numbers improved, the so-called core rates remain quite sticky, and it's the core rates that to a very large degree determine what the central banks are doing.
And in Europe again, so Germany has traditionally been seen as the economic engine of Europe, but it's no longer the case. How can you explain that?
I think you can explain it by simply saying that the economic model of Germany is under pressure, in the sense that, to oversimplify, the economic model was based on low energy costs and exports to China, and both in this geopolitical environment have come under scrutiny and under pressure. And you could also say that productivity of in Germany has declined, or at least it's the gap with other countries has closed, which leads to low direct foreign investments in Germany. Companies prefer maybe to establish themselves elsewhere in other places, and that basically is a fundamental problem for the German economy.
What about China? In the latest issue of Perspectives, you describe the situation as complicated. What do you mean by that?
Yeah, China's growth is still not very strong. The latest numbers are good because basically a year ago the economy was closed, so it's quite easy to register growth rate compared to 1 year ago. But fundamentally speaking, China still has a lot of challenges, and I think the main problem for the Chinese economy is that it still has not succeeded in its transition from an export and investment-based economy towards an economy much more based on private consumption. That's a big challenge for the Chinese economy, and right now it's still not happening, which has led then to overinvestments in a lot of areas, overcapacities, etc., with all the resulting problems. I think that remains the fundamental problem for the Chinese economy. Now the Chinese authorities are trying to stimulate the economy to a certain degree, so that might help a little bit, but the fundamental problem, the fundamental challenge is still there.
Back to Europe then. Is the very tight state of the property market in many countries a key to future trends?
Yeah, but it's not only the case for Europe, but clearly property markets have been impacted by the rise in interest rates, and given that property sectors are more or less important in the economies, that obviously increases the risk of a slowdown, of some kind of a domino effect. So the weakness in the property sector leading to weakness in other sectors, etc. So that's clearly a risk. But again, it's not only a risk for Europe. It's also a risk for other economies.
So has the ECB's policy of substantially raising interest rates had the desired effect?
Yes, that's a good question. You could say that part of the slowdown in inflation that we've seen would have happened anyway. You could say that the improvement in the supply chains has nothing to do with the interest rate policy of the central banks. But on the other hand, I suppose that, yes, given that the tightening in monetary policy has been quite aggressive, you would say common sense would say that has had an impact on inflation too, yes.
So on the equity markets, the improvement in the first half has given way to a downturn, especially in technology. Was this to be expected?
To a certain degree, because the first half of the year was really marked by this euphoria around artificial intelligence that has calmed down a little bit in the third quarter, and that has led to a moderate correction, I would say, in the technology sector.
And then energy remains buoyant at the moment, despite significant movements in the fight against global warming and the huge debates surrounding fossil fuels. Is this sustainable in the long term?
I would say so, yes, because I think the oil price remains and will remain very important for the economy. And there's a big a mismatch between supply and demand. There has been underinvestment in that sector. The demand will remain quite high if the economy continues to do well. So I think that this mismatch between supply and demand will lead in the medium to longer run to higher oil prices. In the short run, you could say if we were to enter a worldwide economic recession, then obviously demand for oil would suffer a little bit, and that might lead to a weakening in the oil price. But again, longer term, I think the oil price will continue to rise.
And in the latest issue of Perspectives, you also point out that the rise in the equity market indices since the start of the year is basically based on the increase in valuation multiples. Sorry, not a good page turn. Sorry about that. Ouais, juste pour ça. Merci. Sorry, Guy. So, in the latest edition of Perspectives, you point out that the rise in the equity market indices since the start of the year is based essentially on the increase in valuation multiples and not on a rise in corporate profits. That's not necessarily a classic scenario in a period when interest rates are rising. How do you explain this phenomenon?
Yes, you're right. Normally, higher interest rates lead to lower valuations and not higher valuations. I think what happened this time around was that at the end of last year, maybe financial markets were taking the risk of a recession much more seriously. Then during the course of this year, they changed their scenario. The consensus went from maybe a recession to a soft landing in the US economy. And a soft landing is traditionally very good for equity markets because it basically means that the rise in interest rates will come to an end. But on the other hand, that the economy will not go down, so that company earnings will not decline, and that, again, this combination is usually good for equities. And it's really this soft landing that the market has now discounted, and which explains why the markets went up despite rising interest rates.
So you also point to the outperformance of the financial markets in Japan. Why is that the case?
I think this story about the Japanese stock market is essentially a story of improving corporate governance. What I mean by that is that in the past, shareholders or profitability was not very important for Japanese companies. What was important, they wanted to gain market share at any price. That often led then to a bad capital allocation, etc. So that basically meant that for decades the profit margins of Japanese companies or return on capital employed was not very high. And this situation fundamentally started to change some 10 years ago, and it's now accelerating. So there's a trend towards more shareholder value, higher profitability is clearly established and will continue. And I think that's the big story behind the Japanese market.
So have we missed the boat on that investment opportunity?
No, I think it will clearly continue. The only thing that might slow it down or even lead to a correction in the Japanese market, again, would be a worldwide economic recession, because the earnings of a lot of Japanese companies are quite strongly correlated to the world economy. So from that point of view, a worldwide recession would be a bad thing for the Japanese market. But that, again, that's more a short-term story. To the medium or long-term story, I think, for the Japanese market is very positive.
So overall, what can we expect for the rest of the year?
Yeah, this time of short-term considerations often it's sometimes difficult to this type of questions are difficult to answer. But I would say that we are now in a situation where the equity markets have discounted a very positive scenario. Sometimes some people call it Goldilocks, as it is famous soft landing. So from that point of view, I think you could say to a certain degree this positive scenario is now discounted in the equity prices. And from here, you could say that either the economy will slow down more than anticipated, that would not be, that again would raise fears of a recession, and would not necessarily be very good for equity markets, or the economy will remain quite strong, especially in the US, which will lead to upward pressure on interest rates, especially bond yields, and that again would not be very good for equity markets. So from that point of view, obviously you could have at the end of the year a traditional year-end rally in equity prices, but the fundamental situation is not very positive.
So what about gold? It's expected to hit a record high in 2023 despite nominal interest rates and the downward trend in inflation. What is driving gold's popularity?
Yeah, as you were saying, the average gold price for this year might register might be at a record high, and you could say that to a certain degree it's quite surprising the fact that gold has held up so well this year, because normally you say there's a negative correlation between gold and interest rates, especially real interest rate, and real interest rates have risen quite strongly this year, and despite all that, gold price has held up quite well. So I think the explanation is that there are other factors behind the gold price, and I think the big factor is the purchases by central banks. Last year, central banks have purchased a record amount of gold. This year, this has slowed down a little bit, but it has remained positive. And I think that's the main factor behind the rise in the gold price, or at least the stability in the gold price. And that, I think it has to do, to a certain degree, with this idea that a certain number of countries, starting with China, want to build an alternative to this financial system based on the dollar. And in this alternative financial system, I think gold might play a bigger role. And that would then tend to explain why, especially the purchases by the central banks of the East are so high.
Yeah. Is it still a safe investment?
I would say it's never speculation, but I think it's something that one should have in a diversified portfolio going forward. Yes.
Okay. Thank you very much, Guy.
Thank you.
See you next time.